Welcome back. Bank Nifty has become the toast of the market after a fairly long, lean patch. In fact, today, ICICI Bank and HDFC Bank have posted 52-week highs. Both these banks, along with Axis, have hurled surprises at us by cutting their savings deposit rates after the Reserve Bank cut repo rate twice, while the state-owned banks, SBI and Bank of India, have expectedly announced term deposit cuts. So does this mean banking sector as a whole has seen the worst of its margins? Now, the other surprise, of course, we got this morning was IDFC attracting two marquee investors, Ardia and Warburg Pincus, into its fold. Warburg Pincus coming back yet again. So banks all over the place in terms of news, and two of them are announcing their numbers over the weekend. To give us an idea of what to expect from this sector, I have with me Rikin Shah, the banking expert from IIFL. Rikin is the Senior Vice President at IIFL. Thank you very much, Rikin. Well, first up, I wanted to ask you this. Bank margins, have they bottomed out with, five of them cutting either savings deposit or, FD rates?
Foremost, Latha, thank you for having me over. Regarding your question on the bank's margin, clearly we have seen the RBI cutting the repo rate by 50 basis points, and our house view is of another 50 basis points of rate cut in the upcoming policies, 25 in June, and subsequently one more 25 basis point of rate cut in this calendar year. Now we have known that usually a repo rate cut is a margin drag for the banking sector and a positive for NBFCs. But the banks, as you rightly pointed out, have responded to this repo rate cuts either via cutting the SAR rates. And it's not only the frontline private banks, but even multiple mid-sized banks, which have been cutting SAR rates anywhere between 25 to 200 basis points in last 2 months. On the other hand, only HDFC Bank, Kotak, and a few other PSU banks have cut the term deposit rates. Net, the way we think about it is that a typical 25 basis point of repo rate cut drives 8-9 basis points of margin contraction in the first year, and subsequently as the deposits reprice, that reverses. But what the banks have done is that with the SAR rates now getting cut, there is some cushion to this margin sensitivity that we are talking about. So this 7 to 10 basis point of margin contraction goes down to 5-6 basis points given the SAR rate cuts that have been done by the bank. And hence the drag on the bank's margins will be lower than what we would have estimated few months ago. But net, just to summarize, I would say that 50 basis point of rate cut is built into the numbers and expectation. And with further 50 basis point of repo rate cuts on table, we'll see more margin pain in the coming quarters for the banks.
Okay. Well, just for the benefit of those who don't use abbreviations much, when Rikin says SAR rates, he means savings account rates, something which all of us have. But Rikin, there is a clear possibility that the rate cut cycle will go even further to probably 5 quarters, considering that we have got inflation rates coming below the MPC's mandated 4%. 3.3 for March and April. The poll I got was 3.1. You can't rule out, is what economists think. So how long does the margin pain go? Assuming that, you're not just going to get in June and August, but also in September. Or if there is a 50 bips in June, who is to say? Then the margin pain is what, only up to Q1, or does it go to all of FY26?
So Latha, we think it's the entire part of FY26 where we'll see margins continue to slide lower for the banks, partly due to the rate cuts in the first half, and subsequently in the second half, even the MCLR linked loan book will see lower pricing because the lower deposit rates will translate into MCLR, and subsequently when the MCLR rates will start going down in the next few quarters. So FY26 margin pain is likely to stay. On the other hand, some other earnings driver like credit costs will start looking better from second half of FY26.
Oh, you expect credit costs to start lowering? For the PSU banks?
Stabilized.
Okay, it will stabilize. I just wanted to ask you whether, there will be a distinction between private and public sector banks in terms of margins.
Yes. So private sector banks typically have around 50-55% of their loan book linked to EBLR, which is largely T-bills and the repo-linked loans. On the other hand, PSU banks have larger proportion of their loan book linked to MCLR. So in the first few quarters, we'll see the private banks margins getting impacted more because the repo linked loans get reset almost immediately when the RBI cuts the rate. On the other hand, the MCLR linked loans will take some time to kind of get repriced. And hence, on a relative basis, PSU banks' margin contraction will be slower and a bit more back-ended vis-a-vis the private sector banks. But having said that, there are a few more nuances even within the private sector banks. Each private sector bank typically has a 1 month to 3 month reset even for repo. For some banks, it get reset almost immediately. For other banks, it may get reset over a month or two. And hence, there can be inter-quarter movements wherein we may see margin contraction coming for a few banks first and then subsequently in the next quarter for the rest.
Okay, then let me just ask you about the results itself before I come with other questions. Which are likely to be the positive ones in the coming result season starting Saturday?
Sure. So, foremost at the sector level, we are saying that the earnings are likely to be very sluggish for the sector as a whole. For the aggregate coverage of the sector, we are forecasting PAT to degrow 7% YOY and grow only 1% QOQ. It's a function of loan growth decelerating, margin contraction, and credit cost still remaining elevated for the sector. Now, within this, individually, we expect banks like ICICI, Bank of Baroda, and HDFC Bank to report better than consensus numbers. On the other hand, three names where we believe there could be misses to the consensus should be Federal Bank, RBL, and IndusInd Bank. The other banks should largely be in line with the consensus expectation, but the overall earnings growth trajectory, as I pointed out, is going to be very weak in this quarter.
Okay, well, actually, let me ask you a little more on IndusInd. Their ultimate number was not worse than the number they had prepared us for. They had prepared us for about 19-20 crores of financial accounting adjustment. It didn't turn out to be worse than that. Does it look attractive now?
Latha, we would refrain from talking on individual stocks, but all I'll say for IndusInd at the moment is that in addition to this accounting derivative loss, whether disclosures out there, the fundamentally as well, the loan growth is likely to remain under pressure and margins should see significant contraction, given that they have raised a lot of funds via high cost certificate of deposits. And also because the slippages are going to be elevated, so there will be a lot of interest reversals and margin pain. In our published numbers, our FY26 ROE for the bank is only around 10%, which is meaningfully below its cost of equity. So it's going to be a slower fundamental improvement for the bank from where we are currently.
Oh, okay, that's a pity. But let me just tune out of results for a minute and then come back. This IDFC news is quite spectacular. Warburg sold off only in March of 2024, and they are now attracted back to the same bank. Will you include that in your coverage? Any opinion on IDFC itself? And is this a positive for the sector itself that, marquee funds are interested at current levels?
Again, without getting into a specific name in detail, many mid-sized banks, including IDFC First Bank, have seen significant correction given their exposure to the MFI sector. Okay. Now, as we stand today and looking at the bureau data, 4Q will see more residual pain for the sector given the slippages will be elevated from the loans which are already 30 to 90 DPD. But the early bucket trends, the collection efficiencies have started improving. And notwithstanding any big negative surprise starting from 1st April when the MFIN norms are getting further tightened and lenders can have lenders can have exposure to borrower only up to 3. We believe that MFI is at the fag end of the asset quality problem. In next 3 to 6 months, the slippages will start picking out and the credit cost may take another quarter or two depending on what kind of lender we are talking about to peak out. Having said that, while asset quality problem for MFI sector will start abating, growth is something which we are still cautious about for the sector. The industry as a whole may not see a significant growth in FY26, and that is where some risk to the MFI growth estimates for lenders are likely to be there. In context of given that asset quality pain is abating, I would imagine that many mid-sized banks who have sizable exposure, including IDFC First Bank, can start reporting relatively better operational trends from next quarter onwards.
Okay. I'm going to ask you a head of research question, but I'm sure you will be in on this advice. Do you think Bank Nifty or banking stocks have a chance of outperformance in the next few months? Because the chorus seems to be that domestic-focused stocks, especially in a country like India, which is largely domestically driven, are likely to do better, and it is the internationally focused stocks that are likely to be a little more wobbly. So, what's the IIFL opinion?
So our house view has been that in the last few months, we have already seen banking sector outperforming broader market. It's primarily a function of flight to safety because the valuations in other sector are relatively a lot more stretched, whereas banking sector valuations are inexpensive. So in that context, banking sector has been outperforming the broader market. But given that we are now talking about a longer and a bigger rate cut cycle, and the earnings growth for banking sector in the entire FY26 is at best going to be low single digit. I think the banking sector can take a breather in the near term. It's only in the second half of FY26 where we believe that as the asset quality starts stabilizing, a lot of margin pain gets behind us in terms of the numbers. And when we start looking at FY27, when the earnings growth is expected to be mid-teens, we expect the banking sector to start again doing relatively a lot more better than the other sectors. But in next few months, as the results kind of pour in, we would see that the earnings are going to be very tepid. There will be some more downgrades in the estimates. And hence, from that perspective, it's not one of the topmost
Top
or
picks.
preferred sector for the IFL within the entire construct of all across the sectors.
So right now, NBFCs will be better than banking.
Yes, some high growth NBFCs would be better placed with vis-a-vis the banks.
Okay. We'll leave it at that and touch base with you after perhaps the weekend. The weekend will be a busy one for you and for us as well, with a bunch of banks coming in. I think ICICI, HDFC and Yes Bank as well coming in with results, and then there'll be more following. But for the moment, I think the Bank Nifty has a lot to cheer. It's not just the best performing index. Two of the index heavyweights, ICICI and HDFC, are at the moment at their 52-week highs. So a lot going in favor for the banking space. Among the other, of course, Eicher Motors and Bharti also at 52-week highs. So a lot of stocks have something to celebrate. Banks have a little more, perhaps. On that note, we wrap up on Bazaar. Chartbusters will come up after a short break.